Next, let us discuss solvency ratios. Solvency is the ability of a business to pay its long-term debts. What we did just now was liquidity ratio, which is the ability to pay short-term obligations, short-term debts. Two main components of solvency ratios are a firm's capital structure and the degree of leverage. Capital structure and the degree of leverage. So we'll have capital structure ratios and we'll also look at leverage ratios. Now, what is a capital structure? What do you mean when you talk of capital structure? Capital structure refers to the sources of finance. You have debt. What is debt? You borrow money, right? Or you have your own money. So it's either an external financing or an internal finance. Own money or loan money, right? So the capital structure may be. The question is, what should be the combination of debt and equity in the business? You may have your own money or you may borrow money. How do you decide what to have, debt or equity? When debt is higher, as can be seen here, what happens is the returns are greater, can be greater, though of course the risks also are greater. I'll show you this with an example. Just a minute. Capital structure analysis is a periodic evaluation of all the components of the debt and equity financing which is used by a business. So now we are looking at the capital structure, that is whether the assets of the business are financed by own fund or loan fund, and what does that mean? What are the implications? If you take more debt, it's riskier. They say it's riskier because we have to repay the debt and we have to ensure that there is enough money at the required time to repay the debt, right? There should be enough cash to repay the debt. Similarly, debts come at a cost. Interest is the cost, and that needs to be paid regularly, right? So both the repayment and interest has to be paid, and if these are very high, if the debt is very high and this is very high, sometimes it could lead to a cash crunch. It could lead to bankruptcy. That is why they say there is a risk of bankruptcy here. However, when the rate of earnings on invested capital is higher than the cost of debt, when the rate of earnings on invested capital, you put in capital in the business and the business earns profit, say at the rate of 10%, while your cost of debt is only 5%, normally the owners, the shareholders, stand to gain when the proportion of debt is more. Are you following? I'll repeat that once more. When our rate of earnings in the business is higher than the cost of debt, then it is very, very, very attractive. A very high rate of return can be had by the small number of shareholders, by the small number of owners. Because I said greater financing is through debt. On the other hand, and this is known as leveraging, we'll come to that. On the other hand, equity is of course own fund, which is permanent capital, doesn't really have to be repaid unless the company is being liquidated. Dividend may be paid to shareholders, but that is only when there is profit. Of course, remember, preference stock dividend may have to be paid first and then to the equity shareholders. Now, greater the proportion of debt, riskier the capital structure, and greater will be the expectations of the shareholders. I mentioned this before also. Greater the proportion of the debt, I said, we could increase the returns, but it also means that the risk to the existing shareholders is more. And that is why they expect and earn a greater return when the company is doing well. Let's take an example, students. Look at this. Suppose you have a company, I've just taken a figure, maybe this is 10,000, these are figures in millions, whatever, but the simplistic example, easy to calculate. Let us say the earnings we made before interest and tax was 10,000. Deduct interest, you get earnings before tax. Deduct taxes, you get the earnings which are given to the shareholders. Capital structure, you have a debt of 50,000 and an equity of 50,000, a total capital employed of 100,000. Now, what is the return on capital employed 10,000 is the earnings, 100,000 is the capital employed. The return on capital employed is 10%, right? And the return on equity, that is, what is the return that the shareholders get? The return to shareholders is 4,200 here, right? 4,200 out of 50,000. 50,000 is just the equity portion. They get a return on equity of 8.4%. Okay, so this is an equal financing. The capital employed, 50% is own debt, 50% is loan debt. Now look at this scenario. We change this slightly where 80% is on to debt. 80% of it is financed by debt and 20% by equity. Okay, again, earnings is 10,000, the capital employed is 100,000. So this is the total 10,000 which is earned by employing both the debt and the equity. That is why we are not deducting interest, right? 10,000 by 100,000, we get 10%, and otherwise the return on equity has now become how much? We got 2520. You following this calculation, students? 10,000 less interest, we get earnings before tax. We've paid tax, 30% tax is what we've taken. On all cases, 30%. You get 2520 by 20,000, giving us 12.6%. Next. Whoa, now the 90% of the capital employed consists of debt, 10,000. Of course, the ROC is again the same, but look at our earnings for shareholders. 1960 out of 10,000 gives you a 19.60%. So if you notice the return on capital employed, that means if suppose these are three different companies, they work efficiently, or the same company utilizes its funds in the same manner. So whether it's own fund or loan fund, they make a return of 10%, right? But higher the amount of debt, the higher the proportion of debt, higher is the return to the equity shareholders, from 8.4% to 12.6% to 19.60%. This is because they are earning 10% return. The debt is only 8%. Mind you, even after 8% of interest, what happens is, since this is tax deductible, this expense is tax deductible, we get a benefit of 30% on the interest which is paid. We get a savings of the savings on tax because of this interest, because interest is tax deductible. So the cost of debt is lower than 8%. And as long as this return is higher than the cost of debt, the shareholders will get increased returns if they finance their growth from taking debt. This is leveraging. But understand, students, that when the earnings fall, the shareholders will face losses. Look at this. The earnings is only 6,000. Okay, less interest of 4,000. Earnings before tax 2,000. Taxes you pay, assuming 30%, 600. You get earnings of 1,400. We are talking of equal debt and equity. So 6% is the return. The return to equity shareholders is only 2.80%. Now, suppose you change the capital structure, 80% debt and 20% equity. Look at what happens. Earnings before interest and tax is 6,000. Interest is 8 into 8, 6,400. Look at the interest, right? Right. You get a loss. Shareholders just suffer a loss. No returns become negative. Mind you, when there is a loss, the shareholders will have to bear the loss. Correct? So this is the problem here. That the greater the proportion of debt, if adequate earnings are not being made, then the shareholders will suffer losses. That is why we say greater the proportion of debt, it is possible to use the advantage of leveraging and increase the returns to the shareholders. But on the other hand, remember there is also a risk of bankruptcy. And when the earnings are not that high, when the rate of return on the business is lower than the cost of debt, then the shareholders will also be very badly hit. Financial leverage is the use of debt, that is the fixed cost funds, to increase the returns to the stockholders. I told you this is what is called leveraging. Debt, if it is very low, it means that the company is not taking sufficient advantage of opportunities. The company with very little proportion of debt could use more financing, debt financing, to increase its growth and the returns to its shareholders. But if debt is too high, it could affect the company's earnings in difficult times. Mind you, debt means there is always a repayment schedule, there are interest payments, and these should not be defaulted. Situation, a cash crunch should not arise, bankruptcy should not arise. The proportion of debt, of course, would vary from company to company and from industry to industry, and there is no standard guideline. So, this is about a kind of relation between the capital structure and what we call leverage. Now, we will independently consider the different kinds of ratios we have.